Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Schlumberger.
If you find our talks useful, please consider subscribe, like, and comment underneath. There is a massive, just a glaring paradox playing out in the market right now that really demands your attention.
Oh, absolutely. It's impossible to ignore.
Yeah, I mean, if you've been watching your portfolio over the last month, you know the broader market has just been bleeding, red screens across the board.
Right. The S&P 500 has posted 5 consecutive weeks of drops.
5 weeks. There is real macro-level pain and fear dictating capital flow right now. And yet, right in the middle of all this widespread panic, an old-school legacy energy company just quietly added $10 billion to its market cap.
$10 billion.
In just 5 days. I mean, to put that in perspective for you, that is like adding the entire total valuation of a major mid-cap tech company to their balance sheet in the time it takes most people to work a standard Monday to Friday week.
It's kind of staggering when you frame it like that.
Right. How does a traditional cyclical oilfield service provider pull off a gravity-defying move like that while the rest of the market is sinking? Well, it turns out they are quietly transforming into an AI technology giant, just hiding in plain sight.
Yeah, we are looking at a textbook decoupling event here. And to really give you a proper audio summary of the situation, the data points to a very strong 7.5 out of 10 bullish score for Schlumberger right now.
Okay, 7.5 is solid.
It really is. But to understand why it earned that rating, you have to look past the historical reputation of the company. We are going to break down the mechanics of why this specific stock is completely detaching from the rest of the market's downward pull.
And more importantly, what this transition means for you as an investor, trying to navigate and build wealth in this crazy, volatile environment.
Exactly.
Okay, let's unpack this. Because when most people hear the name Schlumberger, a very specific image comes to mind. You picture hard hats, massive steel drill bits, and, roughnecks covered in crude oil.
Right, you think of a highly cyclical, heavy industry business. Yeah. The kind that rises and falls entirely on whatever the price of a barrel of crude happens to be on any given Tuesday.
Yes, exactly. But the fundamental data we are looking at tells a completely different story. They are in the middle of this massive strategic pivot to rebrand and operate as a global technology company driving energy innovation.
And they actually have the physical scale to pull off a transition that ambitious. I mean, we're talking about a massive global footprint here.
Oh, massive.
The sheer physical scale is the engine making this entire pivot possible. You really cannot evaluate their digital ambitions without acknowledging their physical dominance. They are currently generating $35.7 billion in annual revenue.
Wow. $35.7 billion.
Yeah. They operate actively in 138 countries and employ over 56,000 people.
That's a small city.
Right. But the fundamental shift from an operational standpoint really accelerated recently with their $7.8 billion acquisition of ChampionX back in April of 2024.
Ah, right, ChampionX.
Yeah, that move wasn't just about buying up more of the same market share. It was a calculated expansion of their portfolio into production and midstream technologies.
Let's define that for the listener really quickly because midstream can sound like industry jargon. If upstream is pulling the oil out of the ground and downstream is refining it into the gas you put in your car, midstream is everything in between.
Right. The massive pipeline networks, the transportation, the complex storage facilities.
Exactly. So by buying ChampionX, Schlumberger essentially bought the infrastructure to cross-sell their new technology to every single phase of a drop of oil's lifespan.
It's an incredible cross-selling opportunity.
Think of it like a hardware store. For decades, Schlumberger was the ultimate hardware store selling the hammers, the nails, the physical pipes, and the heavy equipment to build the house.
The essential physical tools.
Right. But this pivot, it's the hardware store realizing that the real scalable money isn't in selling physical hammers anymore. The real money is in selling the proprietary software that the architects use to design the buildings.
And the digital project management systems that keep the construction running. They want to sell the digital infrastructure itself.
Exactly.
But, it goes even deeper than just providing the architect software. They are generating such massive, reliable, free cash flow from their traditional operations, selling those metaphorical hammers that they can self-fund this incredibly expensive transition.
Which is huge. They don't have to take on crazy debt to do it.
Exactly. They are heavily investing in what they categorize as new energy and digital infrastructure. They are actively using the reliable, boring cash from the legacy physical business to aggressively build out the high-margin, scalable technology business of the future.
But wait, if they are transitioning to selling software and digital infrastructure, that introduces a massive new problem, doesn't it? Tech is a notoriously ruthless space.
Oh, incredibly ruthless.
Right. A startup in a garage can theoretically write a better piece of code. So if you are selling digital tools, how do you stop a customer from just switching to a cheaper competitor when their contract is up?
Well, you have to build a moat. And that leads us right into how they are designing this new ecosystem.
Okay, tell me about the moat.
What's fascinating here is that the foundation of their new intangible asset moat is built entirely around switching costs. If you look at some of their traditional competitors, take TechnipFMC, for example, they primarily focus on selling the physical equipment.
You buy the machine, you use it.
Right. But Schlumberger is taking a different route by offering a deeply integrated web of software, physical hardware, and ongoing IT services.
So they aren't just selling a piece of machinery, they are selling the entire nervous system for an energy project.
Exactly. And that nervous system is getting a massive upgrade. The dominant narrative driving the stock's momentum right now revolves around Nvidia.
Ah, there it is, the Nvidia catalyst.
Yeah, you can't talk about tech right now without them.
Yeah.
The recent moves highlight that Nvidia is doubling down on the energy industry, specifically in partnership with Schlumberger. They're collaborating to build modular, industrial-scale agentic AI factories.
Agentic AI factories. I have to admit, that sounds like a string of buzzwords straight out of a Silicon Valley pitch deck.
It does sound like jargon, I know.
What does that actually mean for a rig operating out in the middle of the North Sea? We need to separate the science fiction from the reality here.
The distinction is critical. Traditional AI, or standard predictive software, acts like the check engine light on your car's dashboard. It analyzes data and tells the operator, hey, this drill bit is getting too hot, you should probably do something about it.
Okay, so it flags the issue.
Right. Agentic AI operates completely differently. It acts like a fully autonomous self-driving car. It doesn't just flag the problem, it actively makes decisions and takes independent actions to optimize the industrial environment.
So it's actually changing things on its own.
Exactly. So the agentic AI senses the drill bit getting hot, automatically calculates the optimal drilling speed to cool it down, adjusts the mechanical pressure in real time without any human intervention, and automatically orders a replacement part from the supply chain just in case.
Wow. Okay, that makes the switching cost argument incredibly clear. If you are an energy executive and you integrate these massive industrial-scale autonomous AI solutions into your daily, minute-by-minute operations.
Your entire workforce learns to rely on that system.
Right. Ripping that out isn't just canceling a software subscription. Ripping it out means shutting down active production, retraining thousands of employees, and risking millions of dollars in downtime.
The operational risk and the sheer financial cost of replacing that embedded technology create a nearly impenetrable moat. It's a remarkably sticky ecosystem once it's installed.
That stickiness is exactly what the market is trying to price in right now, isn't it?
Absolutely. Once Schlumberger's in, they are virtually impossible to remove.
I still have to play devil's advocate for you and our listeners for a second. Every single public company right now is desperately throwing the acronym AI into their press releases.
Yeah, AI washing is everywhere.
We are seeing companies that make toothbrushes claiming they are powered by AI just to get a quick stock bump. It's a market-wide epidemic of exaggeration. So how do you, and I know this isn't just a flashy headline, how do we know Schlumberger isn't just AI washing their legacy business to fool investors?
Applying that level of skepticism to any AI claim right now is essential for your portfolio. But the differentiator here isn't the press release, it's the actual price action and capital flow.
The actual money moving.
Right. The market acts as an incredibly efficient lie detector over time, and the smart money, the institutional wealth, is voting aggressively with their wallets. This isn't just retail hype generated on an internet message board.
Or no, this is much bigger.
The institutional flow tells us that the major players believe this specific technological transition is legitimate and highly lucrative.
Here's where it gets really interesting. Let's look at those technicals and the actual market flow, because the numbers here completely defy gravity.
They really do.
As we noted at the top of the show, the S&P 500 just posted its 5th consecutive weekly drop. The macro environment has been incredibly defensive, incredibly weak. People are pulling their money out of the market. And what did Schlumberger do?
It entered a massive, unignorable momentum phase.
Yes.
The numbers are stark. They strung together a 5-day winning streak that yielded cumulative gains of 15%.
Right. And let's remind the listener of the dollar amount attached to that percentage. That 15% surge added roughly $10 billion to their market capitalization in under a week.
It's wild.
Look specifically at the trading data from March 25th, 2026. On a day of general widespread market weakness where almost everything was bleeding, Schlumberger settled at $51.89, up 2.73% for the day.
And over a tight 7-day period, the stock returned 9.5%.
You and I both know that retail traders sitting at home day trading on their phones do not accidentally move $10 billion into a single stock in 5 days.
No, absolutely not.
This requires massive, coordinated institutional accumulation. Massive hedge funds and mutual funds are buying this up.
The volume confirms the institutional presence. These large funds are completely ignoring the broader macro-weak selling pressure and accumulating shares. The Nvidia catalyst and the AI story are certainly the primary drivers of that growth narrative.
But there is another reason, right?
Yeah. There is a secondary mechanical layer to this institutional buying frenzy. Schlumberger holds the status of a dividend champion.
Which is crucial when the broader market is terrified.
Exactly the point. In a market environment where capital is fleeing high-risk assets because the S&P has been sliding for 5 weeks, portfolio managers are desperately looking for safety.
They had to put that money somewhere safe.
Right. They are mandated to rotate capital into defensive sectors, and traditional energy is prime real estate for that kind of defensive posturing. Schlumberger offers portfolio managers this incredibly rare, almost unicorn-like dual profile.
You get the best of both worlds.
You do. You get the defensive, reliable stability of a legacy dividend payer, combined with the explosive, high-multiple upside of an emerging AI technology platform.
It really is the holy grail for a portfolio manager. You get to survive a market downturn, collect your dividend, report safety to your clients, but you don't miss out on the tech growth boom.
When, where?
However, institutional money isn't infallible. They get caught on the wrong side of trades all the time. To build smart wealth, you always have to look for the sand in the gears.
You have to understand the downside risks.
Exactly. And right now, there are some very real physical, geopolitical realities threatening to derail this entire digital hype train.
The bear case here is firmly rooted in the physical world, creating friction against all their digital aspirations. The company recently had to issue a negative pre-announcement regarding their earnings for the first quarter of 2026.
Uh-oh.
Yeah. They explicitly flagged to the market that they are expecting a 6 to 9 cent hit to their earnings per share.
A 6 to 9 cent hit on an earnings report is significant. If you're an investor modeling out their cash flow, that changes the math. What is the physical mechanism driving that loss?
The drag is primarily driven by severe logistics bottlenecks in the Middle East. We are looking specifically at the ongoing disruptions in the Red Sea.
Right, the shipping issues.
Because commercial shipping lanes are compromised, equipment and supplies are having to be rerouted, often all the way around the continent of Africa. This adds massive transit time and massive cost. This physical supply chain friction is compounding delays with national oil company projects.
And just for context, national oil companies, or NOCs, are the massive state-owned entities. When an NOC delays a project, we aren't talking about a few $1,000s. We are talking about billions of dollars in infrastructure being put on hold.
That physical delay directly hits the balance sheet. And the underlying cause of this friction isn't just a random shipping error. It's the broader, highly volatile geopolitical tension between the U.S. and Iran.
So it's a structural issue.
Right. This macro tension is causing real, tangible delays in Schlumberger's high-margin physical projects.
Wait, let me make sure I have this timeline right, because it sounds crazy when you say it out loud. They actually warned, the market management came out and publicly said, hey, our earnings are going to take a 6 to 9 cent hit because global supply chains in the Middle East are in chaos.
Yes.
And the market bought the stock anyway. They pushed the valuation up 15% and added $10 billion after the company warned about an earnings hit. Is this just pure market denial, or is the AI narrative really that overpowering?
If we connect this to the bigger picture, the market's reaction tells us exactly how institutional capital is valuing this company right now. It is a battle of multiples.
What do you mean by that?
Well, the market is looking at those Middle East logistics disruptions, the rerouted ships, the project delays, and they are pricing them in as a transitory, short-term issue. They see a temporary physical headache.
Okay, so they're looking past it.
Exactly. What they are choosing to focus on and what they are willing to pay a massive premium for is the long-term, high-multiple digital growth story. They are intentionally looking past the current quarter's sand in the gears to focus on the Nvidia-powered future.
It's fascinating. Traditional physical oil field services trade at a very low multiple because it's a dirty, cyclical business.
Yeah.
High-tech AI software platforms trade at a massive premium multiple because they scale infinitely.
Right.
The market is aggressively betting that the tech multiple will ultimately win out over the physical logistics drag.
The institutional flow certainly suggests that. However, responsible wealth building requires us to examine the counter-narrative. TechnipFMC, an independent financial analysis firm, currently rates the stock as unattractive.
Really? Unattractive?
Yes. Their core argument is that the company's weak underlying operating performance and their current financial condition simply do not justify this sudden 15% valuation rally.
They think it's overhyped.
The TechnipFMC perspective essentially argues that the stock is overbought in the short term and that the broader market is being entirely too dismissive of the very real geopolitical risks eating into their margins.
So this raises the ultimate question for you, the listener. We have established this intense tension. On one side, you have a booming, multi-billion-dollar AI narrative backed by Nvidia and massive institutional money flows.
Right.
On the other side, you have a very real, very physical Middle East earnings hit and independent analysts calling the stock overvalued. How exactly should a wealth builder play this stock in the near future? We need a concrete playbook.
The strategy mapped out by the current data requires a specific timeline. We discussed the bullish score of 7.5 out of 10, but the target horizon here is the most important factor.
Okay, so what's the time frame?
Based on current volatility, this isn't necessarily being pitched as a blind, set it and forget it, buy and hold for the next 20 years. The immediate strategy centers around an intermediate-term swing trade playing into the upcoming earnings cycle.
So, if you are taking notes right now or managing your own portfolio, circle April 24th, 2026 on your calendar. That is the Q1 earnings conference call. That date is the immediate major catalyst where this entire narrative gets stress tested.
The numbers released on April 24th will dictate the next major move. You are listening for how management frames the narrative. They have to thread a very specific, very delicate needle on that call.
What exactly do they need to say?
They need to definitively confirm that the new digital revenue, specifically the momentum and actual contracted dollars flowing from the Nvidia AI partnership, is successfully offsetting those geopolitical risks and the increased shipping costs in the Middle East.
Basically proving that the AI money is real and covering the physical losses.
Exactly. If management can show the math that the high-margin tech growth is actively outpacing the legacy logistical drag, the AI transformation narrative will solidify, and the institutional support will likely hold.
So, what does this all mean for your strategy? It's a highly calculated play. You are capitalizing on the broader market's defensive rotation. Portfolio managers are hiding in dividend-paying energy stocks because the S&P is weak. But with Schlumberger, you are simultaneously catching the massive upside momentum of this AI revelation.
Right. It's a dual-threat asset.
You are essentially riding the institutional wave into that April 24th catalyst, using the physical business as a safety net while betting on the digital upside.
The structure of the trade offers a unique balance. The recent pullback we've seen in the broader energy sector hasn't impacted Schlumberger as severely as its direct peers. That divergence provides a degree of relative safety.
Which is nice to have in this market.
Furthermore, the successful operational integration of that $7.8 billion ChampionX acquisition provides a fundamental revenue floor. They have the cash flow, but everything ultimately hinges on that April 24th earnings call, validating the AI revenue stream as a reality rather than just a concept.
To synthesize all of this so you can take it back to your own portfolio, Schlumberger is no longer just an energy company pulling oil out of the dirt. The market is slowly realizing that it is an emerging tech platform hiding in plain sight.
It really is.
They are actively rewarding investors who have the foresight to see past the temporary Middle East logistics issues and understand the compounding power of an impenetrable, highly sticky digital moat.
The evolution from physical infrastructure to digital monopoly is fascinating to watch unfold. I will leave you with this final thought to ponder as you evaluate the broader tech landscape. We spend so much time and capital looking for the next big tech startup in Silicon Valley.
We really do.
We hunt for these tiny, unproven companies operating out of garages, hoping they will invent a product that changes the world. But what if the most lucrative, stable AI investments of the next decade aren't traditional tech companies at all?
That's an interesting point.
What if the real generational wealth is going to be found in century-old industrial giants, companies that already own the physical world, who figure out how to use AI to completely monopolize their ecosystems.
That completely flips the standard tech investing script on its head. It forces you to look at every legacy company through a completely different lens. Thank you for joining Smart Wealth with Joshua. Keep questioning those obvious narratives in the market. Keep looking for those hidden decoupling events where the smart money is quietly flowing. And remember, sometimes the most advanced, highly profitable AI factory in the world looks an awful lot like a traditional oil field. See you next time.